the closing bell. That's okay. We can talk about a lot of good stuff still today. Before we get started, always the disclosures. Options involve substantial risk and are not suitable for all investors. Tradespoon and Keith Harwood, not investment advisors, not registered with the SEC, not registered with FINRA. If you do have questions about your personal financial situation, please consult with a registered financial advisor. The information I will be presenting is provided solely for education and information purposes only. It should not be considered trade advice. Please keep that in mind as you evaluate these ideas and others for yourself and for your particular portfolio suitability. Last but not least, the presenter of this video, Keith Harwood, and or the team at Tradespoon may have a financial interest in the securities discussed today and the trade ideas discussed today. So please keep that in mind as well as you evaluate these ideas and others for yourself. All right. And so with that, hope everybody's having a wonderful morning, getting ready for the big afternoon of Fed decision. Before I get into the trading psychology, I do see a couple of people that I've not seen here before with my, I'm normally on the closing bell, starting to do some opening bells as well. So I'll introduce you a little bit to myself. I'm Keith Harwood. I started as a market maker on the CBOE floor back in 2005. Traded through the subprime crisis, and that's really where I learned a lot about options and how the leverage can really be significant when you're getting the wildness of the subprime crisis and the moves we were seeing then. You know, it wasn't like August 5th this year where we had a 3 or 4 day drop and then just recover and, you know, ho-hum, who cares anymore, for now at least. You know, it was months of just tumultuous, volatile movement, and there was pretty crazy wild times. Good time to be a market maker though, because the markets got a lot wider than they are right now. Markets tightened up after that, got down to, you know, a couple cents wide in a lot of cases, if not even a penny wide in many of these bigger names like, you know, Hughes or Citigroup or whatever, you know, Bank of America. But, you know, back then it was less about volume and more about trying to trade on the wide markets. Now it's more about volume or having an edge in the market. And I recognize that shift. And I decided I wanted to go the route of looking for an edge in the market outside of just being there on the bid and ask and trying to capture the spread. So I moved over to proprietary trading. I was a market maker and prop trader in gold futures options and in the 2, 10, and 5 and 10 year bonds in Europe, the Bund, Babel and Schatz. And ultimately, I ended up working for a hedge fund, a commodities-based fund, for a number of years, doing their option strategies. You know, so basically, that's where I really got involved in this idea of using directional trading with options instead of trading the volatility scope and the skew and all that other stuff. They taught me a lot about technical trading. I taught them more about their options trading. I did their strategies. They came up with the trade theory or the thesis, and I directed them to the right tool to use for the job, in my opinion, for best expected value, best potential for return, balancing out that probability of success and that return on capital. After a few years doing that, I decided to go over to the educational space about 7 years ago now, 7.5 years ago now, and I've been working with investors and traders from every range, from beginners to more hedge fund managers. Teaching them more about how I approach the markets and how I can help them trade smarter. So that's my life in a nutshell here for you guys. But with that, you know, a lot of the stuff that I've recognized over the years is that psychology is a huge part of trading. Vlad knows that as well, of course, talks about it a lot. Compounding investment is really the key. You know, all these other things are important to always keep in mind, but remembering compounding investment is the key to a long-term successful portfolio. And it doesn't mean that I have to have trades on every day. So with a Fed announcement this afternoon, I'm not looking for a short-term directional bias trade in a bank. I'm not looking to hold a position that expires this week in a bank unless I've got a bias on that driven by a long-term trend or something else, I guess. Off of a long-term technical trend, I can hold through this event, much like a long-term technical trend can hold through an earnings event. What can't hold through those, unless that's part of the strategy, is short-term trades. So these short-term trades, if you think that the earnings move is underpriced, that you can get a little bit of a return, or if the FOMC move is underpriced, you can get a bit of a move. But you have to understand that the market knows that it's coming. There's not a lot of people out there that are trading and moving markets that don't know there's a Fed meeting this afternoon. So market knows, which means it's priced in. So now we have to look for our edge elsewhere. Maybe that goes to, for me, I look at sectors that may not be as impacted by the Fed and see how I can get leverage around that without really exposing myself too much to a Fed decision that may or may not go the way I expect. And then I can turn back to basically everything's back on the table tomorrow. And I start thinking about the next event that's going to make me a little bit hesitant. And that's going to be non-farm payrolls on October 4th. So, but I've got about 2 weeks clear after the Fed today of more, there's news, but it's less impactful to me than non-farm payrolls. That's ultimately the big boy. So with that, probability of success and return on capital, this is really an argument of probability of success. I don't see the probability of success I see my probability of success increasing when my edge, which is more technical trading and options analysis, are the two drivers of the trade. When the trade can be driven by an out-on, then I have a problem. I can analyze the technical situation and understand my trigger point of getting in, my inflection point of getting into the trade. And I can understand those a lot better because that's my background than doing a fundamental analysis of what I expect the Fed to do today. And there are other people out there that make millions of dollars a year betting on what the Fed's going to do this afternoon because they're putting all of their time and effort into becoming an expert in that field. And that's not my expertise. That's okay. I have to understand that it's there, and I have to make sure that I am appropriately ready for it as a result. I can find good return on capital out there right now as long as I'm avoiding some of that stuff that's driven by external factors that I'm not as good at predicting. So there's a trade for everybody out there. It's just a matter of making sure to find that trade and then manage the position and know that tomorrow is another day to find probability of success, to find return on capital and allocate the right size trades and manage the risk. It's just as simple as that. It seems so easy, doesn't it? 2 to 3 days to confirm a trend change. So that is one factor that will come into play potentially this afternoon. We are showing signs in the market of being at a short-term top of the range. If we've got a little bit of a red day today and another red day tomorrow, that would probably tell me that we're going to have a retracement back towards the bottom part of the range, and we'll be working on building up a consolidation technical picture. But as I've argued before, I think that the consolidating technical picture actually makes a lot of sense at this time of the election cycle. Really starting around September 1st, consolidation is a big component that tends to seem to happen. Up until the election day, we don't normally, historically, have a big breakout. And I'm really only using the last two elections for this because prior to that, things just happen to be different too, So we're going to see if that trend, even if it's only two elections, continues. But we really did see some sideways action followed by some breakouts. We've got a lot of similar type setups, I think, in the overall world market view as we've had the last two elections. 2020, we were coming out of COVID, but we still consolidated from September and October. 2016, we had, I think, what everybody kind of considered a surprise at the time when Trump beat Clinton. But we consolidated for a month or two heading into that election and then broke out once Trump won. So, the resolution of the election seems to actually be the bullish event, not necessarily who wins, but we'll see if that continues to be a theme as we go through these next couple weeks. Anyway, long story short, don't sell naked options either. Even if we do consolidate, selling naked options is a recipe for potential failure because an outside source of volatility can always come in, whether it's just risk reduction, whether there is a new piece of fundamental news, whether a recession actually hits in a way that the market decides to sell off as a result. A lot of stuff can happen. So selling naked options is potential for ruin. And I never do it because of that. You go back to like long-term capital management and their whole story back in the 80s when their fund blew up because they sold naked put options under the theory that they always went to zero, effectively. They had a complex strategy that we modeled back when I was working on my MBA that it basically paid out almost the exact same payout as just selling short-term teeny puts in the stock market. And so basically it mimicked that the price action of those puts. Eventually they go to zero, or sorry, they go to infinity or whatever. The fund goes to zero when that tail risk event occurs. And the only people that make money in that scenario were the fund managers, because they were getting paid for managing the money. So the longer that fund existed, they were still taking their cut off the top, their share off the top. And since they weren't putting all of it right back into the same fund, they could walk away as millionaires, while everybody else unfortunately walked away with zero. So it was just an explosion waiting to happen, unfortunately. And that happens a lot when you sell naked options. If you want another example of it, back a couple of years ago, there was a guy that was managing people's money, and he thought that natural gas call options looked really expensive per his model. And he didn't understand the potential of a natural gas spike in a cold winter. And so these people that had invested, say, $100,000 with this guy ended up in the red, not just down to zero, but margin call came in and they owed money back to the clearing firms. I'm not exactly sure how the end resolution was on it, but it was a catastrophe. So yeah, avoid selling those naked options and you're going to be a lot better off, and you'll sleep better at night too. Chase trading and revenge trading are a recipe for frustration as well. Revenge trading, it gets you focused on a trade that may or may not exist, just to try to force a recovery from a bad trade. Better oftentimes to find a new symbol, a new trade, and just move on, as opposed to trying to fix a previous mistake or even a good trade that just didn't turn out. Because remember, when we have a trade setup that we think has a 60% probability of success, it means 40% of the time I'm going to get it wrong anyway. So it might have been a great trade, a great expected value, but 40% of the time I'm going to lose money. It happens, okay? Chase trading, similarly, I'm looking to try to get the money that I wish I had gotten when I'm chase trading. So I missed out on the trade and then I decided to do it anyway. That's a bad recipe for trading as well. That's a recipe for failure. So I try to avoid the chase trading and the revenge trading. We all fall into it here and there. When you really feel like you absolutely have no choice but to do a revenge trade, the thing that I do is go to the smallest amount of capital I can put into that revenge trade so that I feel a little bit better. Like literally buy a weekly out of the money call for, 20 cents, so $20. And that appeases me, where if the stock recovers and I make money, it's like, okay, cool. I made it back a couple $100 or $100 or $50. And now I can move on from this trade. And if I lose another $20, it's not going to increase my frustration level. And then that time can pass that I can just move on from the trade. So I basically pay $20 to say that now I would participate within that trade if it recovers. And I'm not going to have to continue focusing on it psychologically. So it's a $20 expense to me. It's probably a negative expected value trade. It's not like a negative $20 expected value trade. But, more often than not, I probably lose a couple of bucks, and that's fine because it helps me with my psychology, and that's important for getting myself rebalanced to the right trading thoughts. It might help me move on to go find a trade that I can make a couple $100 or a couple $1,000 instead. So it's worth the expense to get that off my mind. All right. And with that, yeah, Micron. I still look at Micron, but I now that I finally got a little small winner there and got back to basically break even on it, I think plus or minus a couple bucks, I feel better and I can move on and not worry about it as much and not feel like I have to find a trade to make myself feel better. Sometimes you just get kind of stuck in it. It happens to all of us, whether you've had a day of experience in the market or 3 decades. So Micron, speaking of which, you can just see consolidating here near the lows, and realistically, there's no trade here right now. If I start to see some bullish setups here, follow through. A bullish day followed by a bullish day, that could start positioning for a move back towards 105 to 110. But we're getting these head fakes. A bullish day and then a pullback. A bullish day and then a pullback. And then just consolidation. I think the market's getting ready to give up, but that long consolidation, the longer we consolidate, the more explosive that upside potential really gets to be. So, but for now, it's a watch and wait. And one day I'll look back in Micron while it's trading $1,000 a share and say, gosh, why didn't I get in when it was $90 back in September of 2024? But big boy for us today is still 10-year Treasury and or the Fed. TNX, you can see we tested below 365, closed below on Monday, closed just below on Tuesday with a close at 364. Today trading 367, so yields going up a little bit here on the long-term projection. This is starting to become a bit of a comfort zone. So it was a discomfort zone as we fell here back at the beginning of September after non-farm payrolls. Then we tried to go even further, tested below the August 5th low. That's not a comfortable area to be. But now that we're trading back in an area that we've traded, the market gets a bit more comfortable. Ultimately, for me to get truly comfortable with the 10 years range and staying more range bound, I'm looking for above probably 3.7, kind of get into the higher part of this trend or this box or rectangle, maybe even back up into the 3.8 range. But for now, a little bit safer. If we start getting back below 3.6, starts to get more concerning. If you go out a couple of years, really, 3.25 is our 2-year low radar. But that time as we were falling into a range of stuff that we had already done, then chopped around it and then started to go up. So right now the market's in it's not in no man's land, it's just in no man's land when I consider the last year. When you extend to 2 to 3 years, you start to see some 10-year yield back in that lower range. But the expectation is that we're going to be lowering this yield not because the economy is good, but because the economy is bad. And if the economy is bad, does the stock market have to be bad? It may surprise you that no, it does not have to be a bad stock market just because the economy is bad. It's not always correlated. There are representations that people like to put with it, but it doesn't mean that it's always the case. That's right, 15-minute delay on this. So I'll switch over to live. Also, we get the live view on markets and what I'm looking at this morning. So I mentioned the Fed. Probability of a 50 bip cut yesterday afternoon was 63%, now 59%. We're basically not much more than coin flip here on whether we're going down 25 or 50. That uncertainty creates a bid, I think, to the markets. There's profit taking. You can see the VIX here spiking up to 19.25 today. There's certainly uncertainty. So the only certainty right now is that there is uncertainty. We're seeing it here with the Fed watch. We're seeing it here with the VIX. People don't know what's going to happen today, and it's making them nervous. The market is not seeing the VIX go up because the S&P is liquidating. The market's seeing the VIX go up because people want to either have insurance on their position or are using leverage and defined risk by buying out of the money calls in the case of a bullish reaction to the Fed. So right now there's some insurance plays going on, some leverage plays, some defined risk plays. The VIX is rising. Okay, it makes sense. It's probably now, unfortunately, a little bit too high for where it should be, given where the market is and given what we're really debating for the Fed. But maybe I'm wrong. Maybe the Fed's going to say something that's particularly bearish this afternoon, and all of a sudden we betting on the VIX going any higher than this. I'd say more than likely we're going to drift back down towards probably 16.5 on the VIX coming out of this. Some of this could have come because we had VIX expiration today, so it was doing the settlement. Looks like it settled at 17.8, which is low relative to where we're at right now. But we'll see how it goes. The serial month, the next one's October 16th. I don't really see a great trade here in the VIX options, to be frank. It's just this October 16th expiration, that's going to be within 30 days of the election. So betting on the VIX being sub 16 seems like a fool's game. We're going to have an election premium built into the VIX at that point. Betting on it being higher would be really reliant on the expectation that the market is going to have a dip before the election. So for me, I'm not necessarily betting on anything in the VIX based upon today's move too high. But if it gets back down towards, this 16-ish range and these futures are cheap enough, I think there's a justification for looking at some VIX strategies in October expiration or even out to November expiration and capturing the entire election move instead of just the expectation of an election move, which would be the October expiration. And there may be a trade in the VIX at that point. But for now, it's something to just watch as a signal of what the market's doing. And you can see now already the VIX cash is starting to come off. So some of that spike may have been related to people trying to do some work on getting the settlement price at the right level for VIX settlement today. All right, so back to SPY. We see SPY sitting at the highs. So we had a almost breakout yesterday that seems to be getting rejected, consolidating today, inside day. I'm not surprised to see an inside day. I would be more surprised to see a breakout unless something starts to leak from the Fed in regards to the number of bips and people start to react. So I think we're probably going to be chilling around here for most of the day. Nothing to get too excited about. It's a good day to do homework. Good day to evaluate the markets, prepare for the next day, prepare for the next hour. There's no reason for me to force a trade when I'm not seeing it. I can better use my time evaluating dozens of charts and option analysis setups and find the best, 5 or 10 setups, so that once the move is being priced in from the Fed, then I can start just going bang, bang, bang down my list and find the one that looks the best, if there is one, okay? You mentioned G, so I'll pull it up right now. Yeah, so that's holding right at the highs. So that had that breakout on Friday, a very nice move. And then hanging right here, slowing down the move, so it's decelerating, which is natural. Never got to a 70 RSI, which is actually, I think, a good thing for the bull. Above 70 RSI, you just start to look for consolidation, but there are times where we sit above 70 for a while, as we've seen in a number of individual stocks. Rarer in above a 70 RSI for long, usually. But we're approaching overbought territory, but that doesn't mean bearish. It just means a little slower on the gains, and I can still stay anti-bearish, frankly. For me in this, it might be more of a likelihood of, say, using an in-the-money call spread. Buying a 170, 175 call spread can be a stay in, even in the case of a dip. It's not a huge amount of premium, but 380 for this October 170, 175 call spread. If we rally $5, it's going to be worth about 4.25. So it's like a 10, 15% kind of winner. If we hang out all the way through expiration, make about 30% on a move to $5 on the spread. I usually close these things by 480 or 490 anyway, just to make sure that I've got the profit locked up, just in case. But it takes time to get there. Switching to the other sectors, we've got Qs. Qs a little bit better, still hanging out near the highs. Now, I don't see the bearishness yet here. And I want to mention that because I'm going to show you something that's a little bit more concerning. We saw a low, and then we recovered, but still finished lower, but it was a higher high and a higher low. So these are unclear signals, right? We bounced back into the range of the previous day after creating a lower high and a lower low. We bounced back into the previous range after creating a higher high and a higher low. Today, it's just an inside day. We're in a chopping mode. The Fed's going to dictate what happens next. SMH is showing about the same pattern, but some of the individual names within the semiconductors, like AMD, look a little bit more convicted on the rollover. So we had the lower high and lower low, and today a lower high and lower low. I want to watch for those because we're not buying all the semiconductors right now. There is semiconductor stock selection going on. I highlighted yesterday in the closing bell that AMD could be one for a rollover trade looking to target 135. This is one on my short list of bearish trades. Now, if we get truly bearish, then everything goes down. If we just have a slight bearishness to the market, like, Q's down 1%, that could be enough to trigger a pretty good move here in something like AMD. Once we start getting to 2-3% in these kind of markets, these bigger move days, they all just kind of go to each other. Everything kind of goes to a same correlation, and everything goes up together here. Everything goes down together here. Everything goes down together here within the tech sector. We know that utilities never go down, though, of course, right? So Qs and tech, a little bit concerning, a little less bullish overall than Spiders. Spiders made the new high. tech new high would be over $500 a share. So we're still, what is that? $37, $30 away from a new high. So plus or minus 7%. So tech is lagging right now because small caps are the leader, except for small caps aren't making a new high either. So what is driving this market higher? Well, I mentioned it already. I think utilities are a big part of it. Let's check the Dow Jones Industrial Average. That made a new high, right? So that looks a little bit better, and it looks very different in terms of the chart relative to S&Ps or tech or small caps. It doesn't look like a huge correlation. Maybe on the longer term charts, but on the daily chart, not a huge correlation. The dip here was very minimal. There was the same fall on August 5th. The September fall was not the same. It seems like the Dow Jones may be going towards that utilities style move. And speaking of utilities, you can just look at the trend channel. I got to pull up the trend channel for everybody. My XLU trend channel continues to hold. It did not update the drawing. Sorry, I will. But you can see that it's continuing here. Tried to break out of the channel, which it's done a couple of times before falling back into it, and now fading back down. And I expect it to test the... Nope, still can't. Okay, I'll just update the drawing. I'll just do it for you all. I'll add a couple of days too, because it doesn't take long to get this done right. There you go. All right. I'm getting faster at it with bar charts. So you can see that basically we went from, I can even extend it back a couple of days to make this. There you go. So it's, the lower part of the trend channel is very clear. The upper side is a little bit of a question mark. Is it, pressing against here? That's probably the better spot to put it. And then I could be right on the lows. So there you go. Right on the lows for the bottom part of the trend channel, right on the highs for most of the upper part of the trend channel. Couple attempts to break out of the trend channel and get a steeper appreciation that came right in hand with everything else that was going on August 2nd and August 5th with market liquidation and pulled us all the way down. Right now that we're at the highs in XLU, it's anti-bullish, anti-bearish. I want nothing to do with XLU until it's down at the low side, because at the low side, I can buy in at a price point that is, as we currently look at, whoops, drag that right down. There you go. The low side of the trend channel is like 76.90 versus the high side is, okay. There you go. I can just look at it better there. 77.80 versus 75.25. So we got about a $2.50 wide trend channel. When we're at the highs, I don't necessarily want to buy, even if I have to wait a few days and I can buy in near the lower part of the trend channel for say 77.30 or 77.5. I'm going to feel a lot better about getting back into utilities. And if utilities break out to the upside, I just missed it. So be it. But the leverage, the risk, the return on capital doesn't seem to be there for me in utilities today. But when it gets down to the low side, I can look at a call spread targeting a move to the upper trend channel bar or the middle of the trend channel before October expiration. And I just chart it out. How much do we go up over the course of a month based upon the trend channel? It's about $4 plus or minus. I'd have to double check the number, but then I can just target a price move of about $4 over the course of the next month and go from there. But if I've got a potential for it finishing near the lower end of the trend channel, or even stopping the upward trend up from here over the course of the next month, I'd be more likely to bet for $1 up from here over the next month. And there's not much leverage to that. Okay. So moving away from that, going back towards the small caps. So small caps, we look at, we're testing these highs, we're getting ready for breakout. And this is, I think, going to move a lot today, because of financials. We see the small cap financials, the regional banks doing okay today, getting ready for this news. I think that these could be a big mover once the news is out. That big mover potential is being priced in addition to the fact that we've got earnings starting up for financials in less than a month. So that's going to be priced into that IB30 calculation. But XLF, you can see testing the highs. JP Morgan, one of the big boys, is pulling back a little bit today. And it's one that I always focus on because it had been such a leader for this market. But it's using that 100-day moving average as support. Once we've got the Fed decision, if it stays above the 100-day moving average, then I think it's got a potential to reach. Now, would I be better off being in tomorrow? Most likely. If we get a bullish reaction that pushes us all the way back to 220 off the Fed, I'm not getting in. If we get it back towards 210.5, it's probably a time to be on the sidelines in JP Morgan. So just, this is that homework, getting a little bit of a preparation. Below 205, below the 100-day moving average, I'm not interested. Between the 100-day moving average and maybe this 215 range, I am interested. But above that, I lose the return on capital, because I'm really targeting a move to 225 as the next move if this resumes the bull trend. If I'm trading 220, I've got a $5 bullish with risk down back to the 100-day moving average. I got $15 of risk for $5 of profit. Yeah, the probability of success is high, but to me, there's not enough there on that part of the trade. Okay. We talked about a few of the other banks yesterday. Goldman Sachs, very similar setup using the 100-day moving average. So, similar sort of idea. It's closer to the highs, so it's got a better probability of a breakout. And I'd be more inclined to buy Goldman Sachs on a breakout than JP Morgan at 220. JP Morgan at 220 is below the new high. Goldman Sachs on a breakout. We're setting a new high. We're getting ready for potentially an explosive move. You can always look at any of these other ones like Bank of America. The resistance is lower here. It's at $41. And then there's not much resistance until 44. We go to the regional banks. Key Bank testing the highs here. The big investment announcement that came from an activist investor on August 12th. It's really over the weekend, I guess. I think it came out on August 11th. That was really bullish for regionals. And I'm going to go back to them again for those that missed it on the closing bell. That could be an interesting one on a breakout. Zion, it's a little bit less. It looks a little bit more like some of these other names like Bank of America or Wells Fargo, in that it retested the lows of August 5th and is bouncing back. That could be an interesting one depending upon the kind of move we get this afternoon. I'll just bring up Wells Fargo since I mentioned it. The retest of the August 5th lows. This one's interesting to me. It's got some resistance here between 59 and 61. Something to be aware of. Could be a call spread trade if the other banks are bullish. But ultimately, one that I've been watching for a while now is NYCD. If we get something particularly bullish out of the Fed for these regional banks, but I guess since March, so 6 months, and if that breaks out, I think we're looking at the very least a retest of 15, but I could see us getting towards 20 and more, because people tend to get excited in names like this. It has a little bit of a Reddit trade feel to it when it starts to squeeze. So if this starts to squeeze and the implied volatility is sitting at 50, that over the last 20 trading days, you look at that historical volatility, it's been at the very least about 45% for a short period of time. But generally speaking, we're looking at a 55 plus realized volatility, and the implied vol is 55. So the implied vol is high relative to what it was a couple weeks ago, but it's still too low. The market's moving more than that. So the options are cheap, too cheap is what I'm seeing here. That means that the risk is too cheap. The defined risk and the leverage are too cheap. And you can see it in, the October 18th, 12 calls being 75 cents. If there's a good chance that this going to $15, I don't be interested and excited. But I want to get my full trigger and I want to get the Fed out of the way today. And if this stock goes to 14 off of the Fed decision, then I did my homework for nothing. But I do the homework anyway, because more often than not, something is set up afterwards. And then I want to be in the right trade tomorrow instead of the right trade plus a bunch of wrong trades for tomorrow. And yeah, the rate changes will affect the dollar. So you'll notice that usually, here we go, I'll pull up DXY. So DXY is going to be here at the lows with the 10-year yield at the lows. So as interest rates go lower, usually the dollar goes a little lower. Just the nature of the beast, right? So that's why, when interest rates get lowered, we see the dollar go lower, we see gold and silver potentially go up. And that's what we're seeing right here as well. Here below the previous low, that could be a trigger for the precious metals. If we go out a couple of years, par is really kind of a big number. That was basically the low from 2023, slightly below 100. But, par could be a big psychological number in the dollar, and it could be a big technical number in the dollar as well. So we're going to have to watch this closely. We're really testing here near the 6-month lows, but the 2-year lows here, July 23 of around. If it does break, that's the gold trade again. Gold had broken out. It's consolidating near the highs. And the implied volatility there is on the high side. Silver is consolidating lower than the highs. And I think that's got some better potential for the upside. But ultimately, I've said it, China has a little bit more upside than both of those. If the market gets bullish and the dollar is weak and silver and gold and everything is going up, China tends to have a good correlation to silver. It does show some of our industrial demand and everything else too, of course. But what we're looking at here is I think there's a decent chance of China, FXI, getting a rally. We saw some big flow near the end of the day yesterday. JD.com had a big call buyer. I believe it was October. Was it the October 30s? Maybe it was November. No, it must have been October. Oh, no, it was, whatever. There was a big call buyer in JD at the end of the day, and I'm blanking on what it was because I didn't write down the strike. Maybe it was the December 30s. In any case, it was, I know what it was. It was the 36s. So it must have been, was it Jan 36s? Might have been January 36s. But anyway, somebody betting for some serious bullishness here. And I think it was must have been the Jan 36s based upon the open interest. Yeah. So anyway, that's one name in the AI yesterday, right near the close. Got into the October 25 calls for 64 cents. Actually, interestingly, somebody came in and bought a bunch of those right before the close. So I bought them 20 minutes before the close. And in the last 10 minutes, somebody came in buying more aggressively. Looks like that buying is still continuing a little bit here. People drifting in, paying 75 in small size, but it's just somebody is slowly buying more of these for 74, 75. We'll see if that gets more aggressive today, but the chart looks interesting here. Finally got above the 20-day moving average and setting up some bullishness here. I think that the kind of first starting point for me to those calls around a double by that point. And if we continue through, we could go to 30, and that's where it gets the real big hit. BABA would be another name, of course, to watch in the China space. And this is starting to show some signs of a trending higher. It's like more of a choppy drift higher. You can see that we're continually showing higher lows as we drift higher and higher highs as we drift higher. Above this price point of 86, I think it gets really interesting. So that's another one to watch if the China bull story does play out. Keep an eye on BABA, because above 85.79, there's an intermediate target price point here around 90, but there's not a lot of resistance to this market. And I think it could be very interesting, especially if there's an overall bullish tone to China. Okay. There you go, Bob. Mentioning BABA as well. Sorry. Well, we had the same kind of thought. There's a lot of open interest for this week. 85 is really where they're going to want to try to pin it. There's an outside chance that we get through. If the paper interest is along the call spread, they'll want to push it to at least 86 just to give them some money on that. But we'll see if the money flow into the stock helps pay for the options. October, the open interest is really concentrated here near at the money. And then we get into 85, 95, and then ultimately 100. If we get bullish, 100 is always a big price target. Just the round number thing happens. It works. $100 in December is biggest open interest. $100 in January is big open interest. So in the near term, though, I think what we're looking for is a potential for a move through 85, towards 90. And that fits a lot with an 85-90 call spread, not for September. That's this week. That's not enough time. But 85-90 in October could be an interesting starting point if trying to make sure that we don't bust all the way through. But, an 85-90 call spread here for $1.70, call it. That's a pretty good leveraged return if this trend can continue. But I'll wait, like I said, to get over 86 or call it a dollar rally. That means that this call spread will be worth around another 25 cents. So instead of $1.70, it'll be worth about $1.95. So, but at $2 with confirmed move through the highs is better to me than $1.70 with question marks. 15% more for this call spread with higher confidence than pay current prices with medium confidence. Okay. Of course, FXY, which is dollar yen. That's a big one as well for precious metals. Going back to that, When it broke out, the gold and silver were getting a lot of their bullish flow. So also got to watch this. It's an upward trend, which is inverse of the dollar. So this is FXY going higher is dollar going lower, and this is a strong input potential for those precious metals, and we got to watch that as well. So this stuff on the Fed announcement, so that stuff to just be on the lookout for is some sort of clarity where the market should be moving, precious metals, maybe FXI, and some of this other stuff. Or what the market reaction should be, then let the market be your guide. Watch it. Sometimes you get a head fake move right after. Give it a couple of hours to start finding the trend of the response, and then that's the trade time. So that could be tomorrow morning, because this stuff's mostly going to be, all the news is going to be digested in the after hours. But tomorrow morning could be an interesting time to start looking at some more aggressive trades post-Fed. So, and if nothing looks like it's setting up just right, it's okay. It's another day. There's 250 of them every trading days every year to capitalize on the moves. And if there's 1 or 2 days where I don't have anything great, that's okay. If there's 1 or 2 days a week where I don't have anything great, that's okay. If I'm doing 3 trades a week or 2 trades a week, I can very easily build up a portfolio if I'm doing them well. So, it's all about how your strategy works and how long your holding periods are and everything else to determine whether or not that's going to be successful. That's what we're trying to find, is a balance of trade volume with probability of success. I can touch on Tesla because I know Vlad was looking at that one as a long. I like the way this is looking, but now we're getting a little bit more clarity as well on the technical setup. 235, we've got to get through it. That's the bull setup. It's through 235. It sets up a move to 250, potentially, for me. One could target this range just at around the lows of the pre-earnings gap, 245. But I like 250, round number, good target. And I like it above 235. We've got support, rising support here with the moving averages. So being in with stock makes some sense to me. Being in with calls makes some sense above 235. But with implied volatility here at 63%, part of that's because earnings should be in the next 30 days. It's a little harder. Are still priced pretty high for a potential for movement. And so, for me, probably not an options trade right now. Above 35 with the VIX, with option volatility a little bit lower, maybe I could get in. But then we may be doing that too close to earnings for me to start anew. So right now, it looks kind of like a stock trade to me more so than an options trade, just understanding that a trailing stop needs to be applied and understood here as we create this ascending wedge. Okay. Apple, yes. He is still on Apple. Double check the position. It is it's October 215, 220 call strike. So that looks great today. Bounced off this low, 215, pushed through the 220 level. And it looks to me, from my perspective, price target here in the 225 range. So that was the low of this consolidation period and the high of this period. So clearly that's an inflection point for the market. We tried 225 from the upper side. Once we broke it, we tried it from below and couldn't get back above. That's going to be my ultimate resistance here. A move to 225 is a potential time to change the position or close the position. But if we can get through it, then I'm targeting 232.5, ultimately 237, and then maybe who knows how high. That's going to have to need an overall tech bullish backdrop, but Apple on its own is like 10% accused. So it could be the source of the bullish overall tech backdrop. Did have bearish expectations on the or bearish, analysis on iPhone 16 sales. That's what caused this pullback. So do I expect to move to new highs in the next, few weeks or even month? Probably not. That's probably going to be a post-earnings kind of move. So for now, consolidation with a potential upward grind towards 230, 235, and that call spread that Vlad's got, I think, should be holding okay for now. Still got silver. We already looked at that. So he has this JP Morgan call spread as well. I'll touch on this a little bit more. This, I think, if we can get through here, and really, this is all going to be Fed driven. If we're above 211, you see that was the low here on September 6th. It started to show some signs of being a support level here. A couple of times we 211 type range. It really sets us up to move back to at least 217.5. Ultimately, will we get all the way to 220? I think that's going to be very Fed driven. So we're just going to see how it goes. If the Fed conversation point really gets people excited about financials, I think JP Morgan will be a benefactor of that. It's not going to get left on the sidelines down here at 210 if the whole overall XLF is making new highs. Will it get dragged up to 220? We'll see. Right now, for me, a price target of 219 on the upside would be sort of an initial maybe target. Looking at the high from September 10th and the low from late August seems like a rational spot to target, or looking at even 216.5 here, some July highs. But that, so we got to get a little bit more oomph to it, and we got to get some fundamental input, and we're getting one today. So we'll see how that goes. Option expires, so that's going to keep some premium in that call spread while we're below Vlad's position. But if we get above it, it's going to converge on $5 more slowly, and then it's a question mark of whether to hold that risk through earnings. Okay? But I'm sure he'll as we get close to earnings and we see where we're at. Oh, and he still got Lilly. I thought he had wrapped up his Eli Lilly. Oh, it looks like that was, of course, it was added yesterday, and I missed it. So Eli Lilly, interesting setup here. Testing that 50-day moving average that we bounced off of in last week, or a week and a half ago. So testing those lows sets up for a retest of 950. So this is just trading the range is what I see this as, and doing that with stock makes sense. It's not a buy and hold a call spread or buy and hold a call. You can buy the stock. If the 50-day moving average fails, it's time to get a little bit nervous. If the 100-day moving average fails, it would be very nerve-wracking. From here with, if I'm really strict, being about the low on September 6th of 893, so $15 of risk for $40 of return, $42 of return. It's got a good R&R if this support can hold. So we got to watch to see if that support holds. Maybe, a slightly early exit of using the September 13th high of 942, ultimately target 952. So piecing out some of that potentially. Let's look at BSX for you, Bob. Boston Scientific looks good as a bull flag here. This could be a lot like Philip Morris, or it could be a bull flag. So Philip Morris had a similar uptrend, started looking like it was setting a bull flag, and now it's trying lower. So we know Altria was even weaker. Philip Morris doesn't look great right now. Altria finally stopping its fall, but Philip Morris is now pulling back a little more. We will see how this can play out, but BSX needs the bull flag, needs the higher high and the higher low. And I think that when we're using the really toward here, when that fails, usually the next key moving average of 20 oftentimes will hold for a little while. And then when that fails, the 50-day moving average will hold for a little while. Basically, though, that the 10-day moving average tends to be steeper, although it's about the same as the 20-day right now. The 50-day is less steep. Moving averages are a little less steep, but a little more in line. But for now, the 10-day moving average losing its slope. We'll see if the 20-day moving average can hold and if it can create that bull flag setup. So for me, that's a watch and see. That could be one for tomorrow, though. The implied volatility is high. So this is if it's going to grind higher, it's got to be off the trend and got to be using a call spread. Just the prior high, we're looking at 84, but even the 85s, those are probably worthy of a sale in 82.5, 85 call spread in October, or get into the next weekly in order to be dollar strike specific. And I can take a look at that a little closer, I think, tomorrow if we get the bull flag. What was I going to look at? I had something I was going to look at with you, and then I lost my train of thought there on it. It happens. OIH yesterday had the big run. Today getting a small pullback, but it is a higher high and a higher low. Keep an eye on that. USO is lower today than it was yesterday, but it is bouncing back after initially looking at profit taking. So if USO is going to continue to have this bullish flow, I think people are going to look that much more at oil names and China. Because there's got to be demand from somewhere, and they're going to maybe speculate that it's coming from China, which is a sign of good time to buy into Chinese stocks. Oh, that's what I was going to look at. K-View. So consolidating here near the highs still looks pretty good. Very similar in terms of what I was talking about with BSX. We're using this. I would use this 10-day moving average as a trailing stop for now. but it looks like it likes to do, 2 or 3 days of consolidation and then a bump, and then 2 or 3 days of consolidation and then a bump. So we'll see if that pattern continues. eBay, finally starting to get some of that consolidation. We are lower than yesterday's low. That's a concern. Might be a time to take some profits if I was long. I did not get long. I meant to get long on that day, and I missed it because I was doing a webinar that afternoon, and I lost my focus for a minute on trading. And then the next day, of course, we go way higher. So, sometimes you miss those entries, but it's something that I have been watching. I know Vlad had been looking at this one on the long side. I don't know if he was still long, but one here, if I'm long, I'm looking at this as a very tight leash and just enjoying booking some profits here. If I got long back during the consolidation period or before the big breakout day on September 12th. Okay, what else do we got moving? Let's see if this is moving yet. Not yet. So I pull up Nordstrom's every day waiting for it to break out of this consolidation period. You can see it's a very tight range. 100-day moving average seems to be supported on the low side with one, potential false breakdown. But that was on August 5th when the market was liquidating. Level as resistance. Pretty tight range. Looks like it could be a big mover, though, if it can break out. If retail starts to look good. If we start talking about Christmas sales and things in Nordstrom and, somewhat higher price retail, not the Walmarts of the world and the Targets of the world start to catch a bid, it could be an interesting one to watch. And a lot of times people look at that coming into Thanksgiving, which I know is a couple months away, but stuff to start thinking about now from a seasonality and seasonal perspective. Speaking of Walmart, that's been a huge winner, getting a little bit of profit taking today and could be setting up for a potential entry as a result. So 4 really nice days there. Both flags set up at like BSX would be a really good entry point for Walmart. And the implied volatility is slightly higher than probably it should be. But, if that drifts back down with the VIX coming back off post-Fed decision, that could be an interesting entry. Let's see what the VIX is. Oh, I forgot I don't put in the dollar sign on all the different symbology. So still sitting around 19% in the VIX. So yeah, there's some concern for this afternoon, some hedging going on. But I wouldn't read a ton into it because once the announcement's out, like I said, I expect to see, as long as we don't have a mega bearish announcement or mega bearish commentary, I expect to see the VIX drop down towards 17 pretty quick. Okay. With that, we got a couple minutes left. Is there any other stocks that, are there any stocks that people are looking at that they want to talk about, that they want to evaluate? I can touch real quick on Bitcoin. There we go. Because this could also have a big impact off of dollar movement. It's getting a little bit of a pullback today, not surprising. Bitcoin tends to go up on risk on days. So when you see the VIX higher, it traditionally should mean that the Bitcoin's going down a little bit because it means that people are a little bit leery of potential for movement. And Bitcoin can be impacted by the dollar significantly. So to be watched, but I do like the overall recovery here. It's setting up a wedge, really. I can just show you here, very rough, quick drawing. And then another one. I mean, if I kind of ignore the dip on the 6th and 9th, the non-farm payrolls there, you can see this wedge, false breakdown, recovery, and really getting into an industrial move in Bitcoin. So that's something definitely to be on the lookout for, is a potential for a big Bitcoin move here, especially coming out of the Fed, especially coming out of this consolidation. Ultimately, if it goes to the high side, targeting back to 70,000, and to the low side, could be targeting back to 50,000. So this could be a big $10,000 mover in Bitcoin, maybe over time, but I think the next trend, the next directional bet comes off of this afternoon. So stuff to watch. It could cause a breakout or a collapse in Riot and Mara. I've still got my positioning there. If we see a break in Bitcoin tomorrow and these don't follow suit, If we see a rally in Bitcoin tomorrow and these don't follow suit and they're still down here, I'll look to add into Riot a little bit more. Looking for that to potentially rally here, because if we get Bitcoin back up towards 70,000, I could easily see us pushing back towards $13 in Riot. Okay. What do you got here? Lunar. Oh, wow. More of these space ones. So they've got, okay. So good news today. Good move. So now we got to watch and see how this market's going to approach the day for Lunar. You can see it. We had a spike, a retrace, and a recovery. It's a very short-term trading thing for me on these sort of moves, because usually for me to know whether this trend is if they've priced in the news or overpriced the news, it's going to be built upon what happens next, and that's going to take a couple of days to see. You see here we had a good gap up, and then 4 or 5 days of pullback, and then more consolidation. Just never really got follow through until we get more analysis here on what NAS is doing. So historically, I'm not seeing a lot of breakouts with follow through in the last 6 months. Here's one. So we had a breakout, a couple of days of chop, and then another go. So was that at the same time as the GameStop move though? No, GameStop was later. That was May. Okay. So Lunar could be interesting if it starts to try to repeat more of this type of pattern than what it's done recent history, where gap up is then just consolidation. The options, I would probably look at a call calendar here for September 7th, 9 call versus this week's $9 call. If we just stay here for 3 days, this call is probably still worth about 65 cents, and this call is worth nothing. So being able to get into these for 85 cents and sell these for 60, that's a quarter for a call calendar. That doesn't seem too bad. If one wants to be bullish, I would just raise a strike, go to the 10s. 65 versus 40, so 22 and a half-ish cents is probably executable. Maybe even 20. So if I could buy that for 20 cents and we get a little bit bullish, then I could double my money by Friday and then decide if I want to stay bullish or get out. All right. So for me, that looks like a call calendar setup, given that we're still pricing in more movement this week that may already be done. Neon. Oop, I missed a letter. Neon. Oh, that would be the example of what the bull wants to see in Lunar. The gap higher and then more follow through. I don't know. I haven't followed this at all, so I don't know what the story is behind it. But the markets are extremely wide in the options, basically untradeable. So it's a hard one to get too excited about, because the options are almost untradeable here, but they should be. I mean, we're so volatile here with this kind of move, going, doubling the stock price in a matter of a couple of days. And if you go back a month, it was a $2 stock, and now it's a $14 stock. What do they do? Okay. Learning, so it's learning algorithms, which sounds like AI type stuff, but it's optical sensing solutions sounds like an interesting company. But no, I don't know much about them other than that they're moving. And I can't say that I have an edge on this kind of trade. PLTR continues higher. Palantir is just grinding it out. It's got a bullish trend. Not my style of trade, given the move already happening in the RSI over 70, but it's clearly bullish. And I think that if one wants to be looking to buy dips and just use the 10-day moving average as a stop, as a trailing stop, that could be a way to get back in now. We are getting a little bit of distance to the 10-day moving average. We may be starting up more of this consolidation style that we saw in August again. The news about joining the S&P 500 is out. We know about the investors. So what's the trigger that gets it to go higher? Well, there's potentially two. News that makes it go higher, or prices going higher that makes it go higher. So people just invested pushing to a new high and saying that this is still undervalued where it's at right now, even after the move. But for me right now, it's not my normal style of trade, but if we get a pullback towards 35, it could be an intriguing entry point as we're staying range and showing a pretty decent trailing stop to use at the 10-day moving average so I can define my risk. And really, I want to see us stay above, sort of this September 9th, 10th, 11th initial move range. So I think above 35, it's still pretty good. But that kind of coincides with the 10-day moving average too. All right, well, I'll leave it with with you guys. Well, I'll leave it on that note with you guys, and I'll be back tomorrow afternoon. Good luck this afternoon. I hope you guys have a good homework day. If you find a good trade that is worthy of adding before the Fed, best of luck on that. I hope that you guys find some good stuff as well. But yeah, and then tomorrow, maybe a bit more of a moving day in the market, and we'll see how everything goes. But I wouldn't expect too much drastic movement today. Like I said, I'm just looking for more homework and preparation for the reaction to the Fed this afternoon. Now that I've got, kind of my one trade that I added yesterday. I've tried to limit myself from adding too many trades right before the Fed. So I'll just stick with this one for now, probably, unless I find something similar setup that has that explosive potential. All right, folks. Like you said, about big day. Robert, I am Keith Harwood. If you want to know more about me, go to optionhotline.com. That's my site, and I'm working with Vlad here now and with Tradespoon and Yellow Tunnel, and we're working on some projects together that are going to be, I think, really exciting when we have the chance to announce those here in the near future. So, yeah, it's a good. Vlad's a good guy. Really like working with him, and we're gonna we'll have more coming for you guys as we develop it. So, thanks again, and I'll talk to you guys all tomorrow afternoon.